Hello family, welcome to NQ Daily Market Analysis. Today we're going to analyze price action of the Nasdaq corresponding to January 15th. So let's start with the analysis. We go to what happened at the close of the previous session when price crashed and filled the volume imbalance. So price reached its objective and made a market structure shift. So after making the market structure shift, prices delivered higher, looking for buy-side liquidity above all highs. So market close, and in the Asian session, we can see that price reached this level. So what is this? This is a BC. So this is an order block. The last down close candle followed by an upside movement, leaving a fair value gap. This is your BC. So that's a continuation trade for this one. So the entry was here at the top of the BC, and the stop loss was below the 10-minute order block. So if prices were looking for buy-side liquidity, we look for the chart in order to see where are those liquidity levels. So we can see that we have previous highs there and there and there, and finally, what's that? Those are relative equal highs. And what's resting there? Buy side liquidity. So that was the objective for this market structure shift after rejecting from the volume imbalance, after filling the volume imbalance. So we reached that point at the open. So at the open of the New York session, so by reaching buy side liquidity, we start looking for market structure shifts that tell us that price is going to go to the opposite direction. So I saw this one, I consider this to be a low, then a high, and a lower and a higher high, a breakup structure with a fair value gap here. So I saw this as a market structure shift. The entry is there and the exit is there at the top of the model. But as you can see right there, that wick would have taken this trade out. So that right there would have been a loss. So there were 55 points, but the trade, every trade should represent 1% of the account. So that would have been a loss of 1% of the account. So this point right here is actually, as you can see in the 1-minute chart, the upper part of the first leg of the next 2022 model. That's another market structure shift. So we are still at buy side liquidity. So the job is to place the trade again, now in this model, in the lower part of the CV, and place a stop loss at the top of the sell model. So that's a very big model. There are 81 points, but it doesn't matter. If you adjust every trade to 1% risk on your account, those 88 points will represent only 1% risk on your account. So if we had this model short, we have to determine where it's going. So if we look in the high time frames, we have the low and we have the high. The low is a volume imbalance and the high is relative equal highs. That's the buy side liquidity. So as you can see there, we have a very beautiful big range there. So we measure the range from low to high, and this is your optimal trade entry, and as you can see, this is your equilibrium. So at equilibrium we can see this PD array. So this PD array represents your drawn liquidity, because you have your PD array in confluence with equilibrium. So for this trade, we look to place our profit taking at equilibrium that makes confluence with a balanced price range. So continuing the analysis, we see that price consolidates a while here, then price took this high, went, took these lows, took this high again, and what's this? So I interpret this as another sell model, short. So here's your VC. I mark the VC. So my trade was there from the low of the CB to the top of the CB. But as you can see, price didn't reach it. So this trade never happened. I never got filled. So what happened there? Price took this high. Price took the high. And why did it didn't reach the CB? So we have this from here to here. That's a price range. So we measure the range from high to low because it's a downward movement. And what do we see here? We have an optimal trade entry. So price reached the OTE and took previous highs. So that's why it left this CB open and just started to go down. So these are signs telling us that price is willing to deliver lower prices. So this right here, I see this again as a YouTube model short, high, low, lower high, breakup structure. But the thing with this one is that I don't find any fair value gap. I can't see the CB. So this model doesn't come with a CB, but it comes with an order block. So the order block is there. And as you can see, price respected the order block to the tick and refused to go higher. So while price continues its downtrend, you can still look for opportunities to short the market. So this right there is an order block, the last upside candle before the downside move with a CB. So there's your CB, 1 minute CB. So there's a trade right there. So the order must be placed at the low of the CB and the stop loss at the top of the order block. So if we think that price is going to deliver to the downside, to the balanced price range, this is your balanced price range. So this one is a 10x, and that is because our stop loss comes at 16 points and your profit taking is at 160. So that's your entry right there. After price rejected that CV, we can see this one also. Two upside candles before the down move, leaving a fair value gap. That's your fair value gap right there. So this fair value gap CV makes this order block a high probability order block. So your entry is here and your stop loss is at the top of the order block for a total of 10 points. So you have a second addition. This is your first addition to the trade that you already have. And this one is your second addition. So you should be trailing your stop losses. For instance, if we have our first trade right here and we took this one and the stop loss was at the top of our order block, we can trail our first stop loss to our second stop loss. So we reduce the risk of the first trade. Then we have this second addition, and after we took this second addition, we have to trail our stop losses to the same level, like this. So at this point, we have two winning trades and one that it's still open. So we continue the analysis, and right here we see yet another order block with a fair value gap. So your CV is right here, right there. So the entry and your stop loss is at the top of the order block. So for this second addition, we have to place the profit taking there at equilibrium of the balanced price range. So that would be a 15x, and that's because our stop loss is very tight. It's a 10-point stop loss. That's a precision entry right there. It's beautiful. So we go on with the third addition to the trade, this one. We do the same thing with the profit taking position. We position the TP at equilibrium of the balanced price range. So we already have our first trade with 3 additions. At the moment we placed the third addition, we have to trail our stop losses like this, securing more profits from the first 2 trades and reducing risk for the second addition. And then what do we have here again? If we haven't reached our DOL liquidity yet and we still see more BPR raised to short, we have to take them. So what's interesting here is that this is your range from here to here, and your order block is in confluence with equilibrium. So this is the midpoint of the range. So this gives us a lot of confidence to take the trade short. So the entry should be here and the stop loss should be again above the order block. So once we enter this trade, we have to do the job of trailing the stop losses of our open positions like this, trailing the stop. So at this point, we have our first trade and 4 additions. And this one, we have to, the last trade, the 4th addition, we have to put our TP at the same level of the other trades. So right here I see a YouTube model again short. This is a high, this is a low, lower high breakup structure with 2 CVs. I would have placed my entry there, but price didn't reach that, so price only filled the lower CV and left that open. But that was the final opportunity to go short, and boom, price took exactly our TPs, reaching equilibrium in our balanced price range. You can see it here, right there, boom. So this was a very good trading session. The market offered a lot of opportunities, so this was a very good day. What was needed to profit from this market was to identify our levels. So our levels were the volume imbalance at the start of the move, relative equal highs at the end of the move, the price range, the midpoint equilibrium, and the balance price range, right there. So that would be it for today's analysis. If you learned something, please give me a thumbs up and subscribe. I love you.